Now we can turn to some U.S. data points that have come out, specifically U.S. durable goods and new orders. And again, we're going to look at it two different ways. We're going to take out transportation and also put transportation back in. And here you can see durable goods remained relatively strong, came in above expectations on a month-over-month level. And again, it's a matter of, okay, well, what is being purchased? And we saw this pent-up demand, as you can see, based on the huge drop-off, through March and April. And now we're starting to see some of this normalization come through. The question is going to be, now that you have the loss of that additional monetary value coming through on a fiscal stimulus, you have some concerns now arising again regarding jobs. How will that continue? And that should have been an issue this month, to be brutally honest, and it wasn't. So it's a matter of, okay, well, what does this mean going forward? Because when we start to look at, which we'll talk about in a little bit, about credit card data, what is happening with rates, some of the tightening that we're seeing, this is going to become a bigger issue, especially as people can't afford to operate on their daily expenses. You're going to see a lot of the savings come from this specific region. But at the same time, when we add back in U.S. manufacturing new orders, you can see it remained elevated. This was above expectations. We came in at about 6.4%. I'm sorry, 6.4%. Percent over month over month. So again, you're getting some of this follow through. You're getting some of this manufacturing, and it's really coming from the loss on the storage side. When we consider what's being held in inventory, where our inventory levels, we continue to see inventory levels are getting to a point where they're going to have to be refilled. They're going to have to restock. And we're starting to see a lot of these orders get kind of pulled through, which is why it gives some confidence on the manufacturing side when we're looking at new orders that this is going to continue. But we also have to consider that typically unemployment is a lagging indicator. So we have to decide, is this U.S. manufacturing new orders, is this going to be indicative of new, people getting hired again, people coming back, because now businesses start to feel a little bit better. They're going to pick up an extra shift or maybe restart an additional assembly line, something that could start to turn things around. It's still too early to say because there's some friction in terms of what we're seeing and some of the data points. But again, this is what we're looking for as we go through September, because now this should have gone down in August because we lost some of the spending, some of the additional support on the fiscal side, and it really didn't materialize. So that's why we have to reassess and say, okay, well, what is this going to mean going forward? And that's when we start to weigh some of the different data points, which is like some of the high frequency sides on just the amount of trade that's coming into the U.S. We see imports dropping. Now, imports dropping into the U.S., we saw a big spike, and now we're starting to see things come down. We're starting to see some of that slow down on the shipping side, but you have to consider there's a lot of work here because the U.S. dollar weakened on a relative level considerably. And when you think about the weakening of the dollar, imports become more expensive. So as imports become more expensive, you start to pull back on some of those imports. And as the dollar declines, some of those exports could become a bit more attractive depending on their end user. But as we said earlier, some of those fiat currencies abroad got a little bit weaker. So they weakened against the dollar, so you didn't really see that kind of pickup. But those are the different weights that we have to look at. South Korea, some of that export data came in a little bit better than expected. Imports continue to disappoint. And again, that's where we continue to see some of these problems. Some of the import levels remain weak, even though some of the exports have started to climb back a little bit. But again, well off of where we were last year. So on a seasonal level, on a year-over-year level, and as we look at it on a 30-year time horizon, things still remain well off norm. And there doesn't seem too much because, again, it comes down to this stagnant moves as we go forward. And that leads us to those stagnant moves and looking at some of the stringency indexes. And this is looking at it a little bit differently to understand, okay, well, what does stringency mean and what does it look like when we adjust it for GDP? And you can see that we're starting to come to the end, and we've seen comments out of Florida, out of the US in general, as well as India and others, where lockdown just won't happen again. We're past the point of effectiveness. People won't do it. We've seen that even with a lockdown, is it really relevant, especially given what we've learned about COVID in terms of treatments, in terms of shortening hospital stays, and really minimizing the actual death rate? So that's why I think it's fair to say that we really won't see lockdowns or forced lockdowns the way we have. We will see restrictions in terms of local levels, and then the consumer themselves will naturally adjust in terms of protection to make themselves feel a little bit more comfortable about, their situation. But again, that comes down to that consumer side of the spending equation. And then that leads us directly into some of the ISM data points. And it's key, it's important to appreciate kind of where we sit based on where the survey was, where the actual was. And you can see it was a beat pretty much across the board. ISM employment remains a headwind, but let's just pick apart some of these numbers. So ISM manufacturing, again, positive. And then what gives us confidence that you're going to see an additional volume movement in terms of this going a little bit further, ISM manufacturing is going to take another step up. And the reason why we can say ISM manufacturing is going to remain relatively strong is because the new orders, again, continue to surprise to the upside, but it's surprise to the upside in obviously a large number. And again, it comes down to some of this loss of inventory. Now, the bigger issue is the employment side. So employment remains below 50, which means we're still contracting. It's still above the prior, but again, this is where we continue to see some of these issues on the employment side, and it's something that we're going to talk about in a bit more depth on the next segment. Now, some of the data points from the ISM, something that stuck out, and here's a quote from it. Key to the upturn was a jump in new export orders, which again, weakening dollar, some of those movements, which rose at the fastest rate in 4 years, reflecting improving demand in foreign markets and benefiting larger corporations in particular. Now, that's a key component because large corporations continue to benefit. We've seen that in some of the consumer movements and some of the data in terms of purchasing. But on a disappointing side, new orders and export sales at smaller manufacturers continue to fall, highlighting an unbalanced recovery in favor of larger firms. That is going to be a bigger problem as we see the bankruptcy numbers that continue to come out. Bankruptcies remain a headwind in the market, and it's really being driven by the lack of consistency across this recovery. If you have the money, if you have the balance sheet, if you have the economies of scale, you're seeing some of these benefits, while a lot of the smaller entities continue to struggle to kind of see that uplift, which is an inherent problem as we continue to go forward. Because again, the small business is really what drives the U.S. economy, what provides a lot of employment, and we're just not seeing that really start to make that turn and start to get some of those benefits, which gives us a little bit of a pause in terms of, well, how sustainable is some of this rally? How much of it can we really see kind of carry forward? Now, with that being said, this comes down to the customer's inventory levels, and we continue to see the customer inventory levels come off a steep drop. So guys were trying to save money, work through inventory, find ways to kind of get to the other side. But now we're getting to this point, and this is going back to 2013. You can see that inventories are well off of where they normally are, which is something that we expect to see a little bit more restocking. And if you watched our EIA show, we talk about trucking. We see a lot of trucking demand. We see a lot of truck movements. We're starting to see a little bit more movement on the intermodal side, specifically on rail. And this is all in essentially looking to restock those inventories, get those goods where they need to be, and to see some of that movement in the supply chain return, which again is a nice tailwind to have, versus some of the headwinds that we see persisting on consumer comfort, credit card spending, and just employment in general, which is what we're going to talk about in the next segment.